or good morning, depending on when you're listening to this. Scott Pinkerton here, managing member of FourThought, and I'm joined with Jake MacFarlane. Welcome, Jake.
Hey, Scott, thanks.
CFA. This is, the second time we've done this in a month. We did a economic review last month and spent a good hour with slides, et cetera, and then decided not to send it out because everything had changed and everything had changed with the election. So we did a reboot, and we're talking today about Trump 2.0, the economy, the election, and your future. There's a couple of slides we want to talk about beforehand, but first, just real quick, what we're going to do today is we're going to look at some of the relevant proposals and promises and expectations of the president and his new cabinet and the new government, and what that's going to do, what impact that's going to have on the economy and on the financial markets and your portfolio. Then we're going to also look at what's been happening, what was already kind of baked into the cake, and what cards he's already been dealt with, and how that's going to impact stuff. And then at the very end, we're going to wrap things up with, what do you need to do today to play defense? What do you need to do today to play offense in case things work out well? And what specific plays are we recommending that you take? Before we get into today's topics, though, in great detail, remind everybody that in these webinars, there are no recommendations for you specifically, and that if you have any concerns or questions, feel free to talk to one of your CFPs here at FourThought. And of course, Jake and Scott are there. You have see our bios. Wonderful. Love to talk about myself even more, but time doesn't permit it. And of course, schedule a time to talk through your personal portfolios. Let's get right into our topic today, Trump 2.0. I mentioned some of the issues. The first is going to be taxes and immigration. And then we have the inflation issues, high valuations, government spending, foreign policy, Federal Reserve. These are issues that we're going to have to wrestle with, what we've been wrestling with, and are going to have a new sheriff in town that's going to have a different approach. So if we get into taxes as our first topic. So Jake, any questions first of all?
Well, I think the big picture, right, as we remind ourselves, right, why we had this recording and then decided to do it over, Scott, was because of a kind of crazy election result, right, in which we saw Trump win presidency, but also Republicans win the Senate and the House. So obviously, in terms of support there, Trump's going to have a lot of leeway to try to enact policies. Perhaps first on the agenda would be on the tax side, right, Scott? So what are you seeing being proposed? What are you seeing maybe being likely as put through, and what kind of effect should that have?
Well, when you go on a scale of 1 to 10, 1, it's probably not going to happen. Definitely not going to happen. 3, unlikely. 10 being absolutely, and nothing's really a 1 or a 10. But I would put this first thing as probably an 8. It's really likely that the 2017 Tax Act that was put in place when Paul Ryan was chair of the House, a lot of those are set to sunset in 2025. One of the biggest things is, for example, estate taxes, where you have a unified credit, which is the amount that you can leave to the next generation, was basically doubled, and that was going to sunset, which means it would go back to the previous level. So it's like 13 million. It would go back down to 7 million or so. So it didn't impact the number of people obviously, but the impact on those people was pretty great. And so you had this scrambling that was taking place as people were preparing for those tax cuts to leave, which was really causing the estate planning community a lot of business, and clearly that has a high likelihood of just being extended. Another big issue there was the corporate tax rates. And so when you look at the valuation of the market, everybody talks about price to earnings, and when things are overvalued, they are high price to earnings. When they're undervalued, low price to earnings. Well, the earnings are going to be directly impacted by the amount of taxes that you pay. So we would look at, if these expired, about a 5% across the board corporate tax increase. And obviously that's off the table. So it doesn't necessarily provide a big catalyst for the stock market moving forward like it did in 2017, but it won't take that away. So when Trump got elected and it was a Republican sweep, you saw a bump right away. And one of the reasons was obviously this expectation that analysts had on those earnings, tax earnings, going down. Now their modeling is saying, yeah, their earnings are going to be more. And then by having those future models of earnings being greater, they're giving a fair valuation of a particular company a higher valuation. So, lower taxes is going to mean more valuable, earnings, more earnings, which is going to create more value for the stock market. There's another thing called the SALT, which is state and local tax deduction. And it's a big deal, especially if you live in a state like New York or California, where your local property taxes, income taxes, capital gain taxes, I mean, it can be 12% of someone's income in some instances. And what happened in 2017 is they capped that. That was primarily Democratic states benefited, more than Republican states, and so it got through that. And a lot of the states have kind of gerrymandered away so that people are getting maximum tax deduction. The odds are that that's going to probably be lifted, but I wouldn't put that as an 8. I would put that as a 5 or a 6. It really isn't as impactful as it once was because of the individual states, having those changes. Jake, have you heard much about this domestic production tax? It's interesting.
Yeah, and so it is interesting. Maybe on the lower end of that scale of likely to be passed.
Yeah.
But
how would they ever enforce it?
On overtime?
How would they ever enforce it?
I don't know.
Yeah.
Yeah, it seems a little bit far fetched, and maybe just something that maybe caught more news than it will catch fire in actual practice. But there's a lot of proposals out there.
Well, there's a thing in Europe and in many countries where they have a value added tax, and things get taxed at different levels of the production process. And there's been people talking about, hey, that's the way we should move. It's really kind of a giant sales tax when you think about it, which is sales taxes are generally regressive, meaning that it hurts poor people because they're spending more of their money on stuff and less of their money on investments and savings. But that's a side issue. So that we do have some precedent of taxing, of government taxing stages of the production, and that could happen. It's going to be a complete watershed change of the way we do things. You can imagine if you're manufacturing a Ford automobile and you have some of the components made in Mexico, some of them made in Korea. They come here and they're assembled. Where is that tax levied? So that's going to be complicated, but it could happen. I wouldn't give it a 2. It's not preposterous, but we'll see. It's got to get through Congress. And then finally, tax cuts for some very select folks in the working area, like, for example, tips. Have you ever been to a Sonic?
Oh, yeah.
Yeah. So part of, when you get Sonic, you used to get it delivered to your car, you tip people, right? So imagine you have a fast food worker that works at Sonic. They make a little bit less because they make it up in tips. And you have a fast food worker that works at McDonald's. They don't make any tips. And so we're going to give preferential tax treatment to the Sonic employee over the McDonald's employee. I think that's going to be, really hard. But I hear, for example, the president of Uber, the chairman of Uber, was in Mar-a-Lago having a conversation about how taxation of tips might work. So I wouldn't say it's something that he's not serious about. I think he's serious about trying to implement all of his promises. But this one, I would as an odds maker, I'm not sure it's going to have a strong likelihood of getting through. Maybe it's a 4 or 5, but perhaps I don't know. The taxes on Social Security is a big issue. That's been a promise, and that's going to have major consequences to the budget, and it could happen. And then the last one we had was, of course, overtime. I don't know. I think once that occurs, you're going to have a lot of people playing with the way in which they're compensated so that they're paid more at overtime than regular stuff. So, yeah.
Yeah. there's certainly a lot we can go through with tax policy and how that might trickle down into the economy and ultimately into earnings. But the immigration policies could even be more important. And this seems to be obviously a top priority. It's garnering a lot of headlines within various news services, and it's been a really great driving force of labor force growth over the last couple of years. So Scott, what are you seeing there in terms of immigration plan and how this might really happen over the next few years, and what kind of effect it might have on the labor market?
Yeah, I need to make sure we're focusing on the impact on the economy and investments, but kind of big picture, there's two schools of thought to think about. First, the pro-immigration conversation, which is when you have a strong foreign workforce, it tends to reduce the cost of labor, which obviously is a big component of inflation. When you look at the PPI, the producer price index, the majority of that is labor costs. So, having a lower cost of capital or lower cost of employment is positive on the inflation side. One of the things that when you look at countries that are thriving, they do have a healthy immigration policy, and they have a larger number of foreign born workers. You look at countries like Japan that have been more stagnant. Perhaps that's one of the issues. So you have that over here. On the other side, this is supply and demand, and the type of immigration that we're getting here in the United States has been overwhelmingly on the lower income side. And so this has disproportionately impacted those Americans that are in that workforce, because you have more supply or more, same demand, but more supply, the cost of that product is going to go down. And that's exactly what's happened. So, and then you have a bunch of issues that are beyond economics, like fentanyl and, a lack of control of the border. Those are clearly non-economic issues, but they're very important. And they're going to, from what I've heard the president-elect say, it doesn't matter what it's cost. We've got to stop this. So what the impact is going to be in the short term, I think we could see some inflationary pressures on things like agricultural products. And you're going to see when you go into restaurants, potentially, a shortage of workers, landscaping, et cetera. So I do think there's going to be some hiccups from an economic perspective. In the long run, as the economy starts to understand and get this underway, you're going to see more mechanization, like you're going to a restaurant and you're going to be ordering more online and more towards that stuff. So that could have a short-term negative effect. And it means that inflation is going to be potentially a little bit more stubborn. And then the next thing to talk about is, go ahead, Jake.
Well, just one more point on this too, right? There is a balance when it comes to inflationary pressure on expanding labor force, but also expanding productivity, right? Those two kind of go in the opposite direction. So if we have a labor force that's shrinking, that's inflationary. But Scott, to your point, if we have increased productivity, whether through machines or AI or different things like that, that's disinflationary pressure, right? And so which one of those scales sort of tips? And I think you're right. Probably in the short term, it's probably the more inflationary pressure.
Well, the other thing to think about is I was listening to Rory Sutherland talk about Brexit. He's an English former advertising guy, but he's a great thinker. And he said that the elitists were saying that Brexit would be a bad thing because it would increase wages. And they completely fumbled because they were using this as a reason to vote against Brexit. But the average English person said, well, increased wages is good, right? And so what might be inflationary to an investor is higher wages to a worker. And so, how does that impact the economy and investments? Clearly, it could be a negative from an investment perspective, but in the long run could be very healthy for the economy. But nevertheless, when you have fentanyl and other issues coming over the border, it's a problem that needs to be solved. And so we're going to have to deal with the impact. So bottom line, when we get into implementation, be prepared for sticky inflation, I guess, is the bottom line. Now, we don't need to make judgments of whether it's right or wrong, good or bad. It's happening, and it's probably going to be a net add to inflation. for all the whether it's good or bad. But one of the things that's coming
So
up is deregulation, Jake.
yeah, absolutely. As we look at kind of the next big picture items that seems to be of major importance to Trump and staff, deregulation and tariffs kind of come center front as well. And so, Scott, there are different thoughts here on whether these are more just especially looking at tariffs, right? Are these actually policies that are going to be implemented? And if so, we can draw maybe some conclusions on what that might do to the economy. There's also a thought that these are more used for negotiating tools as well. But kind of walk us through what you're seeing in terms of deregulation maybe first, and then we'll pivot over into tariffs.
Yeah. And again, we're not the global experts on this, but we've been, we did quite a bit of reading in advance of today's webinar, obviously. Let's talk about deregulation. This is where it can get really exciting. So again, you have two schools of thought. There was an opinion piece that Vivek Ramaswamy and Elon Musk wrote in the Wall Street Journal maybe a week or so ago, and they laid out a case for how they'll go about deregulation. And basically, they're pointing to two Supreme Court cases that were recently ruled on. And the most famous one, I forget the actual title of it, but it's generally known as the Chevron doctrine. And what happened in the late 70s, I'm sorry, the 90s, it doesn't really matter, but there was a law passed by Congress, and it was the implementation of the law and the application of the law was done by a government agency. Chevron contested that, and the Supreme Court ruled that, hey, if there's no specific instructions, the experts within the government agency are going to be given preference to make rules. Well, the Supreme Court has eliminated that. And so Elon Musk and Vivek Ramaswamy, DOGE, which is the name of this Department of Government Efficiency, their position is this, that they're going to identify all of these regulations that are not explicit in the law, but are made by government agencies. And honestly, that's got to be the majority of them. There's so many of those. I mean, I can tell you examples of developers, for example, that can't develop in Arizona because 300 years ago, there was a creek running through it, and the EPA has a regulation about that. And so what's going to happen, according to DOGE, is that they're going to go in and universally say, okay, here's the 800 to 8,000 to 80,000 regulations that we think are circumspect, and that Trump, by executive order, can stop those regulations. And in the future, if someone challenges that, if that's a good regulation to have, for example, then Congress has to pass the law. So that's their position. And if that position is true and right, and I'm not a legal expert, then there is an opportunity to dramatically deregulate. One of the big things that happened in the first Trump administration is they established a rule that if you're going to establish one regulation, you got to get rid of two. And it's hard to track what the impact of that was, but clearly any business person can tell you that one of the frustrations that you have today is over-regulation. Now, one person's regulation is another one's lifesaver, but nevertheless, this is an issue that governments around the world are facing. So I think that that's the one side of the coin. Now, the New York Times today, again, it's December 4th, had an op-ed or an article, I should say, on the likelihood of this being able to happen. And their reporting, and I don't pretend to know, their reporting is that they've interviewed legal experts, and the way Elon and Vivek are thinking that this will work ain't so. Yes, they can be challenged, but it's going to be by court cases. And they point out that it's giving that power not back to the executive branch, but it's giving the power to the courts. And so they see this as a major, major impact on deregulation, but perhaps not as sweeping and as quick. It's going to be more of a drip of deregulation as these regulations get challenged one at a time. So any questions about deregulation? That's kind of our position, which is it can be hugely positive from an economic perspective. It can be hugely positive from an investment perspective. Will it be quick or will it be slow? We'll see.
Yeah, and one point that that we've seen too is just a general slowdown in like merger and acquisition, so M&A activity. We'll see if there is a sweep of deregulation that sort of happens, whether it's quick, whether it's slower. We could start to see that activity come back online as well.
Right. Yeah, and the tariffs is
And
a
so Scott,
little harder.
getting into tariffs, yeah.
Yeah.
What are you thinking there? I mean, there's a lot that's been said. Will that be put to the table, or is that more of a negotiating tool? What's your read on it?
Yeah, and again, this is not Scott Pinkerton's read or Jake's read. It's the collective read of our investment committee as we've digested information from various sources. And my personal observation is that tariffs, generally speaking, are bad. When I was in college, we were kind of schooled on what happened in 1929 was the Smoot-Hawley Act, which said, hey, we got to protect our manufacturers and our producers. And so the whole globe put up these tariffs and it threw us into the Great Depression. So since that point, there's been a general recognition that tariffs are bad. And I think in the 60s, it was an example of where German trucks received a tariff on American goods or when they were coming into America. And then they retaliated by putting tariffs on some of our agricultural products. And what's crazy about this is they still exist, and they just, it's sand in the machine. And Adam Smith goes back to the power of productivity is to have specialization instead of having every state in the United States make its own sneakers. We understand that maybe we should have our sneakers made in Oregon and our oranges grown in Florida rather than having state tariffs on. So and that is true for America and it's true for the world, but we live in a world where not everybody agrees to free trade. And I think the point, especially made by Trump in 2016, is that China, and everybody knew this, one of the things that they were doing is they were stealing our intellectual property. And that, so you invent something, and then if you're going to sell it into China, they're going to steal it. So that's a big issue. So, you can get into the political punditry of, are these tariffs, are they really going to be real? Are they going to enforce them? What's the impact going to be? Is it just a negotiating tool? We have as investors to put that to the side. The reality is that if the bluff is called, the tariffs will go on and it will have an impact. Short term, there's going to be some disruption potentially, maybe a step backwards in the cost of products and the availability of products, but those supply chains will start to iron themselves out. Will we have successful negotiations with Mexico and Canada and some of our closer trading partners to iron out some of the issues that we have there? My guess and my hope is that we do, but certainly tariffs in and of themselves, they're not good, and they're not going to be good almost in any way, shape, or form for the producers or the consumers. But sometimes you have to, take a step back, and getting into whether it's good or bad. But obviously, if the tariffs are large and they stick and they stay, it could have a negative impact on the economy. So let's switch gears and talk a little bit about, Jake, some of the things that that he's inheriting. First is the strength of the economy. I read an article today, France is in trouble. They've got this new premier, Michael Bernier, I think is his name. He's been in there since September, and they're already calling to oust his government because he's trying to reduce spending. We'll get into government spending in just a second. But you have a country like France that has had no growth basically for 10, 15 years, and that's a problem. So having growth is critical. So where does the United States stand, and what's the economic situation as far as our growth?
Well, there's the good, the bad, the ugly. Certainly growth has been great. And that's something that is certainly a positive that Trump's inheriting. If you look over the last 4 quarters, our economy's basically printed 3% real GDP growth each quarter. And, looking forward, the GDP continues to still have strong expectations. it's a result of the strength of the consumer, even through going through inflation that sort of trickled down. It's a testament to productivity enhancements, as well as the strength of the labor market that we've seen over the last 2 years. And so certainly from a GDP standpoint, the United States is in a great spot. Maybe the best spot of any country that you could really look at that's developed and that has an economy anywhere near as large as the United States. So certainly he has that boding well for him. We're actually, if you look on the chart here, eclipsed that historical trend GDP growth. And it's actually interesting. Once that happens, right, we're seeing this positive output gap. That could be a little bit speaking to inflationary pressures as well. So we'll see, if that comes into play. But from a GDP standpoint, certainly our economy has been humming along.
Yeah, and notice how much of our GDP is consumption. So the world and America is driven by American consumers, and that's critical. So inflation, Jake, is reportedly coming down. Can you break it down for a little bit for us and compare it to, say, for example, where it's been and our outlook?
Yeah, absolutely. So looking at the chart here, we see, the light blue line, which is going to be that headline CPI. And that's where, the Fed wants to get down to like a 2% target. And so we're not quite there yet. The recent print as of August was about 2.6%. It is below the 50-year average, which is over 3.5%. And so we're making meaningful progress there. What we're looking at is the path from where we're at now, 2.6, down to 2%. That's a really tricky spot because you're working off of some base effects where looking a year ago, we had some high CPI prints that are rolling off as we look at the last 12 months. But also the Fed's trying to navigate this without sending us into a recession or also impacting the labor markets too much either. So it's we've spoken about this before, how the Fed really has to thread the needle. They're taking their foot off the gas, and they've actually started to implement some rate cuts. It'll be interesting to see the position that they take as the new data comes in. Will they continue to cut or will they take their foot off the gas and pause a little bit? And that probably is going to come from the different components of inflation.
Right. So the thing to keep in mind though is the Fed's got to thread this needle. If they allow the economy to slow by keeping rates high and by other measures, then you risk tipping yourself into a recession and losing that growth. But if they don't slow the economy, you have inflation. And so that's a really tough lever to pull. And you do have to kind of get into the components of it. And what's fascinating, Jake, walk us through this graph and really share with us the things that have been sticky and what we see happening in that area. And I've got some comments too.
Yeah, so I've got a 2-year-old boy at home who's just obsessed with dinosaurs. And so when I look at this chart, to me it looks like the inflation stegosaurus, where you've got that hump there that happened in 2022, and it's certainly come down a good bit. But over the last couple quarters, it's been a little bit more stagnant. However, when you break it down into its components, we can see that over 2/3 of inflation is still now coming from shelter, which is that dark blue. If you look at the charts, just shy of 2% of the 2.5% that we see. And we'll get into some of the real-time data on rents, but that looks favorably to continue to shrink a little bit. And if you look over the last year, that blue line, that blue bar has shrunk, but it's done so at a very, very slow pace. Whereas some of the other components, especially like energy, can be a lot more volatile and can go from a big chart positive to, even if you look below the zero mark, you'll see that green bar has been negative for a couple quarters too. So what we're thinking there is, as we look forward and kind of extrapolate this, that blue bar and even the red being auto insurance, hopefully, those will continue to shrink, and that could, positively move inflation lower towards that 2% range. But we're also cognizant of some of the more volatile components such as energy, food, and core goods. Those have been kind of benefiting inflation over the past couple quarters. If those start to spike, that could really send inflation higher and put the Fed in a pretty tough position.
The reason inflation is pointing so low is we have that huge drop in energy prices, which could reverse as our economy strengthens. Why don't we get into that shelter CPI on the next slide, and we'll come back to this conversation, Jake. This is interesting. What is it showing us as far as the lag time on rent and CPI costs?
Well, you've got two different line graphs here, and if you look at the orange line, it's U.S. rent index. What is that index doing on a year-over-year basis? Comparatively, the blue line is shelter CPI on a year-over-year basis. And if you look on the left side of the chart, it basically goes from 2020 back to 2014 or so, and you can kind of see that there wasn't a lot of volatility in either of those lines, and they kind of moved in step. However, once the pandemic hit, we had a big spike that happened in the U.S. rent index. Rents went sky high, supply was very low, demand was high. And what eventually ended up happening, as you can see, is the blue line increased with a little bit of a lag. It certainly did it a lot slower than the orange line did. And what we're now seeing shake out is the exact opposite, where rents have really fallen year over year, up just 1%. And we're finally starting to see the shelter CPI come down a little bit, but it does it at a much slower pace. And that's why we think, hey, if rents continue kind of at this pace, or even have a little bit less pressure there, we would expect that the shelter CPI would continue to go lower.
And our next slide talks about another component besides rent, but let me make one comment about rent. Our sources, one of our compatriot organizations does a lot of work in multifamily housing, and their latest quarterly update was, we're not seeing rates come down. I mean, they did come down, and they're stabilizing and actually going up now. So I think the projections that rents are going to continue to drop may be a bit premature and may not be as far as the people on the ground saying that. But rents is one component. Another component is actually the cost of housing, and that's been stubborn. Jake.
Right. So again, another series of line charts here. The purple being a national home price index. So as this goes up, and it has, certainly over the last 30 years, but especially since 2020, it's gone up. That just means that home prices are higher than they were before. Whereas the orange is going to be the affordability index. As this goes up, that means homes are more affordable. As it goes down, it means that they're less affordable. And so you can kind of see those moving in opposite directions, where home prices are still high and they haven't really come down, even with rates spiking. They just haven't really gone up either. But the affordability has certainly pulled back. And the wallet share, towards housing has become more and more for those looking to own a home. So that's been a really interesting factor to look at as well. Will this break? Will rates, staying high finally kind of give in to home prices pulling back a little bit? That's something that's kind of to be seen. But certainly the affordability index would point to consumers looking to rent maybe more than owning as well.
Right.
And keep rents high.
Yeah, and the reality is that the Federal Reserve can cut the Fed funds rate, but it doesn't necessarily impacting mortgage rates. Right. So, if you look at the next slide, Jake, the stickiness of inflation and the cumulative effect is really what's happening and having an impact on folks. But let me just make one more comment about housing. Obviously, nobody likes to see people not being able to buy their first home, and nobody likes to see stubbornly high, shelter inflation. On the other hand, could you imagine if housing prices dropped? What the headlines would be? What's going on with our world? People's net worth is tied into their housing. They're feeling poor. That's going to affect their confidence as a consumer, and you can just see the ripple effects. So be careful when you've got an illness that the cure isn't worse than the illness, and that's the difficult job of the Federal Reserve. But the cumulative effect is really important because those numbers might be 2%, but how does it make you feel, Jake?
Yeah, it's kind of like the grocery store effect, right? And we're hearing that inflation's coming down, but if you think of what inflation is, it's still an increase. It's just
Right.
increasing at a slower rate. And the Fed has a 2% inflation trend. So if you take, the CPI going back historically at that 2% trend, that's the blue line there, where we should be at if inflation just printed 2%. Where we're at is the red line, and we've annualized over 4% in CPI since the beginning of 2020. And so that cumulative effect puts us 11% above the trend line being at 2%. It just kind of shows you the compounding kind of nature of this, and really on consumers weighing on the wallet share, even as inflation's coming down. So it's sort of counterintuitive where you should feel better, but your wallet still feels worse.
Right. So getting into the next important thing besides inflation, and a big component of PPI is wages. So Jake, what we're seeing here is the dark line is unemployment, and you see wage growth. So where are we at on wages and unemployment?
Absolutely. So with wages, we're still growing, and it's above the 50-year average, but just barely. We're at 4% wage growth, 4.1%. The 50-year average is 3.9. So we're kind of
Yeah.
right along that long-term trend line. It's real wage growth, which is great, but it's also not kind of out of control, and it's not adding a lot of inflationary pressure to this point because productivity and the growth in the labor force has increased so much. So that's really been what's kind of also allowed inflation to come down a good bit. What the Fed is more worried about now, and why they started to change policy to ease, has been what's been seen in the labor market on the employment side. So unemployment has crept up. It's at 4.2%, still well below the 50-year average. But the data has started to look comparatively worse, whereas the data on the inflation side comparatively has looked a little bit better. And so that's what's kind of allowed the Fed to kind of pull that reversal there and start to cut.
Yep. And then when you look at the next slide, this is great news. I mean, wages have been growing greater than inflation, and that's what we want to see.
Yeah, absolutely. When you compare wage growth to inflation, we're now at a positive number for the 17th straight month, which is great news, coming off the heels of 25 consecutive months of negative real wage growth. And this chart, I did it kind of going back to the early 2000s to kind of show the scale. And where we're at right now is kind of a normal scale in a growing economy. It's not out of control like we saw kind of coming out of COVID or coming out of the 2008 recession either. So kind of to the point of inflationary pressure, I mean, we'd really have to see real wage growth continue to kind of skyrocket for that to have, I think, meaningful impact on inflation, provided productivity increases, and also provided that the labor force gains don't completely dissipate or get really negative due to immigration policy.
So let's talk about the labor demand. So looking at our next slide, we're starting to see people not getting their not being able to job hop as much, and there's the unfilled positions just aren't there, and the quit rate is going down. So walk us through some of those numbers.
Well, we get data from a lot of different sources, right, Scott? And so at our investment committee, we kind of have the advantage of not having to be force-fed a house view, and we can gather data from different sources and try to pick which outlook we think might be most realistic. And so some big institutions are calling this just a reversal back to the pre-COVID norms. And in some instances, I do agree with that. If we look at job openings on the left side, that's come down substantially since March of 2022, but we're still above the pre-COVID highs there as well. So there are still jobs out there. But where I disagree with that, this just being a return to normalcy, is on the quits side. And that's going to be on the top right. We've seen the quits come down well below the pre-COVID high there. And so to your point, Scott, people aren't jumping around. They're not getting more competitive offers elsewhere. We've also seen, especially within big tech, they're really tightening their belts around employment. It's been accused, let's say, of Amazon doing their return to office as being kind of a way to reduce headcount without having to fire people or lay people off. So, but certainly these big tech companies are tightening their belt around the employment market, and we are seeing a little bit of stress on the labor side, and that's something that's been confirmed by the Fed as well, and their meeting and in their policy action too.
Yep. So what does that mean for you as an investor? It means again that we have this issue with inflation and how it's going to be there's going to be some conflict between the two, and we start to see inflation being stickier. However, wages, maybe that growth is going to slow down, and that will be a counterbalance to that. Immigration, it's basically a soup of issues, and you're not going to be able to take one and say it's the pea that makes the soup delicious and not the carrot. It's all part of the soup. So consumer finances is a huge element of our consumption. We saw that was 70% of our GDP. What's the state of the consumer, Jake?
Well, there's multiple fronts to look at how the consumer's doing. Number one, if we look on the balance sheet, the consumer's in a great spot. They have a healthy amount of assets. Still, home prices being elevated is supportive of that, but also financial assets. I mean, the stock market's done incredible over the last 2 years, so that's certainly propping that up. But that's also being a lot driven by kind of the baby boomer region as well. Those who own their homes, have a ton of equity in their homes, have large 401ks, et cetera. Whereas on the right side of the graph here, looking at debt service and flows into delinquencies, this is a lot more of the younger folk in the economy, or even kind of the lower income segment too. We're starting to see some stress there, especially within auto loans and credit card loans. Those flows into delinquencies are kind of approaching that region before the 2008 financial crisis there. So it's something that we're keeping our eye on. We're pretty worried about the consumer, and for good reason. It's a major part of our total GDP.
Yeah, you look at the retailers, and the story that we've often heard is that the high-end retailers and the low-end retailers do really well. It's the middle that's doing poorly. And right now, Walmart's doing great, Amazon's doing great, the high-end retailers not so hot, and the low-end, Dollar General's gotten crushed. So our normal tea leaves from stock performance isn't really helpful. But consumer savings rates and total consumer debt, obviously, this is a big deal.
Absolutely. I mean, the savings rate is well below the historical average, and that if we look at different periods, right, we're kind of right where we were in the early 2000s, which was not a great period. Had a couple of recessions there, and it's sort of maybe pointing in that direction of, hey, consumers are spending more of their wallet share on maybe rent, housing, insurance, different necessities, and they aren't really saving, but they are still consuming, just to a lesser degree, and maybe that's being propped up by credit. And so we see total consumer credit outstanding above $5 trillion. I mean, this number just keeps going up and up and up. The rate of increase isn't extreme, but just that amount of debt, especially on items like car loans and overall just credit card loans, is getting a little bit high, and it's feeling a little bit uncomfortable, something that's probably not sustainable long term.
Yeah, I wouldn't get too fearful, because that's a nominal number, not a relative number. So we have a percentage versus a total, but consumer debt is climbing. There's no question about that. And then is the consumer spending starting to slow?
Right. Retail sales obviously is something that we keep track of. We have a couple of retail companies within our portfolios. One that we track is Target, and they got crushed during their last earnings call. And one point that the CEO really harped on was that they're seeing consumers really tighten spending on not on discretionary purchases. And maybe that's why Walmart is doing comparatively better. More and more folks just really leaning into grocery or non-discretionary goods, whereas some of these other companies, especially like luxury goods, different things like that, really are being hampered much more. But overall, retail sales still positive, just under 1.5%, but well below the average of 4.5%. And if we look at this on a inflation adjusted level, that typically averages 2% year over year. And right now we're at negative 1% almost. So really below that metric as well.
So to kind of summarize, we talked about the Trump tariffs and their policies, and we looked at the U.S. consumer. GDP growth is good. Inflation is coming down, but we have strong feelings that it probably won't be coming down anymore. And so there's good, and the U.S. consumer, their spending seems to be slowing. So as the Federal Reserve has raised rates, we're starting to see the impact of that. And we don't see a lot of impetus to see lower inflation. So we think that that's going to be stubborn, and it's setting up for a conflict about what the Fed's going to do. I think you're going to start to see them turn the ship from saying, hey, we're going to have 5 rate cuts to maybe 2 rate cuts, and then we'll see if we have any. Another thing that we got to start paying attention to, and we've been talking about this for 10 years, is our federal debt and government spending. So you're seeing in France today protests on the street. You saw it in South Korea. The guy declared martial law, and it's all about this conflict between who's the problem in our society today. Is it government or is it business? And big picture wise, you're seeing a push to basically rein in government spending, and people are pushing back against that, especially in countries like France, where they did some nominal changes and they're ready to oust the government. I guess the good news is they can only oust one government a year, and so they have to let the guy sit on it for a while. But with our own federal debt, it is a big deal. And these are some simple graphs that show the consumer's government spending on the left, how much of that they don't control. So if you look at what Musk and Vivek Swamy have to do, is, if you take out Social Security and Medicare and interest on the debt, that's 50% of our spending. So reining that in under control is going to be a big deal. You'll see on the bottom right, that orange that shows the government spending. That's going to be the increased deficit that's going to come because the tax cuts that were promised or tax cuts that were propagated in 2017. One shows them going away, and the other one says that they're going to be kept. So think about that being a little bit higher. So federal finances, deficits are high. They seem to be going higher, and that's one of the big challenges for the next administration. The next graph gets into two levers that the government has to deal with. One is their balance sheet, and that's when the government during the last financial crisis, one of the things that they wanted to do is they wanted to push interest rates lower. And we've always talked about how the bond market controls those interest rates. And so what the federal government did is they couldn't get the bond market to buy more bonds. So they went out and printed money and bought bonds. And so the federal balance sheet ballooned. And the Federal Reserve has been very good about letting that balance sheet mature. And so you can see how the federal balance sheet has actually started to decline, and it's been going down nearly every month. So that's a big positive. And that's taking money out of the economy. It's slowing the economy. Money supply is going down, and that should be a positive for inflation. Inflation is simply too many dollars chasing too few goods. So if we take money out, that could be having a much bigger impact, for example, than interest rates. So the next slide, let's get into what the Federal Reserve has been doing. And you can see they've been cutting interest rates. And you can see the projection of what those future cuts are going to be. And the green is the market expectations. They're expecting deeper cuts, the Fed's expectations. But the conventional wisdom is now that interest rates are going down, I think that could be a negative surprise that the Federal Reserve doesn't have the ability to continue to lower interest rates. What you want to be careful of is this next slide, which is the decoupling of what's happening in the bond market and with interest rates. So this is interesting. You can see in September, the Federal Reserve we're looking at the 10-year Treasury on the bottom and the 3-month Treasury on the top. So the 3-month Treasury is much more tied to the Federal Reserve's Fed funds rates. And you can see that how that rate has come down as the Fed cut interest rates at 50 basis points a couple months back. Interestingly, what happened to the 10-year Treasury, it went the other direction. It went the other direction. So interest rates on 10-year bonds have actually gone up, which is counterintuitive, right? You'd think if they lowered interest rates, it would go down. What is going on? What's going on is that investors are not willing to lock in their money long term because they think inflation is going to be there. So heightened inflation concerns are going to be reflected in higher bond yields. And that's, when you look at a long-term government bond, that's how mortgage rates are calculated. So one of the stubborn things that people are frustrated with is, hey, the Fed's cut interest rates. Why haven't the mortgage rates come down? That's why. And so in our history, we've had these things called the bond market vigilantes, which is the government can say, this is what we want to do. And the bond market says, this is supply and demand. You've got to borrow the money. And we're going to bid for each other about how much, interest you're going to have to pay. And, the less confidence they have, the more interest you're going to have to pay. So you're starting to see, globally rates start to creep up. Countries like France, you're seeing, that their interest rate is kind of competitive to Greece now all of a sudden. Still at 3%. It's not like a big red flag. But again, this is something to be watching. The ability of our government to do things is going to be limited by the bond market and other activities. Let's get into valuations, Jake, and we got to really look at the stock market and its valuations now. And we have one last slide, I guess, here on Bitcoin. One of the things I want to stress is that when people lose confidence in the dollar and fiat currencies, you're going to see these things start to catch a bid. Been a great investment this year. We don't recommend it. We think that that's going to be a loser in the long run, but it is interesting to look at. So let's talk about valuations, Jake.
Yeah, sure. So where the S&P 500 is at today, certainly well above the long-term average. If we look at price to earnings ratios over the last 30 years, the market has had an average of just under 17 times earnings has been where the PE is at. Whereas right now we're at 21 and a half. And so we're kind of approaching the valuation we saw post-COVID, where we had just an incredible run-up in the stock market in 2020 and 2021. And then before, 2022 sent the market lower towards a more, average PE multiple. Well, we're not there now. Right now, the market's overvalued relative to historical average PE ratios. And kind of what that tells us is maybe there's a little bit of speculation in the market, but also in terms of earnings growth expectations, analysts are really expecting 10% growth in earnings over the next 3 years. So with that kind of comes into play, that investors are willing to pay more per dollar of earnings in today, expecting more growth. And that's what we're seeing. But also keep in mind that that's a greater risk in investing in companies with higher PE multiples, because if those growth expectations miss, it can be quick to reprice back to a lower PE multiple.
So bottom line is that valuations are high and they're concentrated on just a small number of growth stocks. Jake.
Sure. So that's really becoming another key risk. Is not only is the market expensive, but it's more and more concentrated in these top 10 mega cap companies like Apple, Microsoft, Nvidia, Amazon, as well as some others. And right now, if you invest, $100 into the S&P 500, about $36 is going into just 10 stocks versus, 500 in total. Not only is that just concentrated looking over through the market's history, but also these 10 names they're expensive. Number one, they trade at an average of 30 times PE multiple, so well higher than the market or the historical average. But they're also pretty pretty correlated with one another too. In that if Nvidia is down, it's probably going to also bring Microsoft, Amazon, et cetera, down with it. So that's just a risk to keep on the horizon. And the correlation also helps on the upside as Nvidia has continued to do well, and these other companies too. It's kind of been the tide that's lifted all these boats as well.
Absolutely. And I would just point out that Nvidia, for example, their stock price has gone up, their price earnings multiple has gone up, but their earnings have gone up too. Apple, their PE multiple is in the 30s, whereas 10, 15 years ago when we were buying it, it was in the 12 and 13s. And their earnings have gone up and their stock price has gone up and their PE multiple has gone up. But now we're starting to see their earnings start to slow. And so the question is, will they be able to support it? And this is an example of a company that I picked out. I just know it from Cisco. Jake, you want to walk us through what this slide shows us? And it's basically pointing to the danger of overpaying for a company.
Yeah, absolutely. Well said. I mean, this is the perfect stock to pick on here for investors. If we look at Cisco heading into the 2000s, they hit a market cap of over $550 billion. If we look at them today, and also since 2000, from then to now, almost 25 years, they've grown their earnings by basically 1,000%. I mean, their earnings were, they reached a low post 2000s of actually negative, but heading into 2000s, they had earnings in the 10 cent to 20 cent range. Now their earnings per share is almost $3. So an immense amount of earnings growth. And you would expect that company would be worth more today. In fact, Cisco is less than half of the market cap that it was in 2000. And that's that multiple correction. You had a stock that was growing earnings, had a lot of promise coming into this new age of internet. And for all intents and purposes, they executed on what they were going to do, and they grew their earnings really nicely. But that growth really pulled back over the 25 years, and the market discounted that firm, from maybe paying 50 times earnings to
60,
paying
70.
more like 10. Yes, paying more like 10 times earnings now. And
so valuations
really
matter. Yeah. Valuations matter.
Yeah, absolutely.
So, we got a quick comment on foreign policy. This is going to have a huge impact. And I don't know what to tell you, but, buckle up your seatbelts, because you got two big things happening. You've got internal domestic strife in country after country, like we witnessed this morning, South Korea, France, other countries. Everyone's starting to face this issue of, hey, we don't have free money anymore. We had a period of time where Germany for years had negative interest rates. That creates a lot of false stimuluses in an economy, and that's getting sucked out. And it's going to be painful for people. And you're going to have a lot of sacred cows that have to get slaughtered, and it's going to be tough for everyone to take the pill that Argentina has taken. So just, comment on that. Let's get into our wrap up, Jake, with what our playbook is. What you'll notice is we want to have kind of offense, defense, and what you should do today. There's some things to be very positive about. Deregulation, tax cuts. If we get if the tariffs work and the scare of tariffs work, and you see free trade blossom, that could be a huge positive. I can't expect that everyone's going to just acquiesce. There's going to be some conflicts. There's going to be some implementation times. But as long as we see bright things on the horizon, prepare for, I put legal immigration. If we can come out of this process with having enhanced legal immigration, that'll be a huge positive for our country. We need to have a sensible policy like other countries like Canada, where we're allowing engineers and doctors in, as well as, other people on that pyramid, not just everybody on the bottom, and not letting these people in. It's crazy that we have people that go to the United States for engineering school and nursing school, and we need nurses and engineers, and they can't stay and they want to. Prepare for defense. Inflation could turn higher. We're looking at that bond decoupling. So you want to have your defense play defense. You don't want to take your risk in the bond portfolio now. You want your bonds to be high quality and short term so that you have that money available for safety purposes, for spending purposes, and also to take advantage of any kind of major disruptions in the economy that could come from things like a tariff war or exasperated inflation. So offense, don't panic, invest in the technologies, look at some of the positive things that could happen from deregulation. That could be enormous. Defense, make sure you rebalance your portfolio, have your bond portfolio solid. We would recommend, as far as calling your plays, reducing areas, investments in the areas that are overpriced and rebalancing into more value-oriented stocks. Maintain a little extra cash right now to take advantage of disruptions, and stay focused not on what is proposed, but what actually gets done. And that's going to be a big difference because you're going to have, folks announcing policies, and they'll announce that they want something that's bright yellow when what they're actually hoping for is something that's almost with a tint of white in it, but they have to start with the extreme and negotiate that, that down. So we all know this, and we know that when organizations and people take positions, that it may not be where they think. It's just a negotiation. And then Warren Buffett is an interesting one to talk about. He has done two things. One, he's very consistent in his conversations about never doubt the United States of America, never invest or bet against us. And that's one of the richest men in the world. It's been a huge success for him. But also you look at his personal decisions, and they've liquidated trillions of dollars of stocks, or billions of dollars worth of stocks. They're having the highest cash position that they've ever had. So optimistic long term, short term, kind of a hesitation. So to wrap things up, I would say Trump 2.0 is going to be radically different than Trump 1.0. One, he's coming in with a different type of cabinet, and it's going to be much more disruptive. And I think there's going to be confrontations that's going to cause a lot of angst and anxiety. And you're going to see the media blowing things up and doing like the media does, which is bad news sells. We want to understand that the long-term trajectory is still positive, that the underlying economy is still positive. We want to be prepared, and we want to take some profits now so that we have some dry powder to take advantage of opportunities as they emerge. We think that the future for America is fantastic, especially if we start dealing with these long-term problems of our government spending, and that's going to ultimately hugely inflationary. It also sucks a lot of the productivity out of an economy, and the deregulation. So long-term positive, short-term be prepared for disruptions. Make sure your defense is safe and you've got the cash flow that you need. Jake, would you add anything?
No, I think it was
great. So to wrap things up, remember, great planning requires forethought, and we are so appreciative of your business. And again, God bless and have a great holiday season.